Switzerland has not fought a war since 1815. Its currency has, over the same 2 centuries, appreciated against every other major currency in the world. The US dollar, sterling, the euro and its predecessors, the yen, the renminbi. There are no exceptions, and the trend is not slowing. This is the story of how one country, with a population smaller than New York City, built a monetary system so durable that economists across 2 centuries of theory, Hayek, Mises, Rothbard, Cantillon, keep finding their predictions confirmed by Swiss data. It is also the story of why that durability is not automatic, and why, even for the franc, the future is no longer guaranteed. The Swiss franc, in its modern form, begins in 1798. Before that date, more than 70 distinct entities issued their own coins across the cantons. Payments were made with billons, small coins that changed character at every cantonal border and were not always accepted beyond them. The Helvetic Republic imposed a unified franc across Swiss territory for the first time. It looked like rationalization. It looked like progress. To the Austrian economist, it was something else. It was the first step in a 2-century process of monetary centralization that always ends the same way. With a central bank, with fiat currency, with the quiet erosion of purchasing power. That Switzerland's journey through this process produced a franc that still stands as the world's strongest major currency is one of the great ironies of monetary history. The Swiss franc survived the 20th century better than almost any other currency, not because centralization worked, but because the political institutions surrounding the central bank, direct democracy, the cantonal structure, fiscal discipline enforced by local accountability, recreated at the political level some of the disciplinary pressures that competitive monetary fragmentation once imposed at the market level. The constraints had moved. They had not disappeared. From 1850 to 1936, Switzerland operated within the international gold standard framework, first through the Latin Monetary Union, then independently after the Union's collapse during the First World War. When currencies are anchored to gold, their cross rates are essentially flat. When the anchor is lifted, the divergences begin. Switzerland adhered to gold convertibility through the interwar period longer and more tenaciously than most European states. Swiss voters did not want inflation. Swiss cantons resisted fiscal transfers. The Swiss National Bank, founded only in 1907, late even by European standards, was structurally cautious and institutionally conservative. The critical moment came in 1936. Switzerland was the last major country to abandon the gold peg, reluctantly devaluing the franc by 30% after France, Belgium, and the Netherlands had already done so. Even this devaluation was experienced domestically as something close to a betrayal of the principle, a trauma that shaped Swiss monetary culture for generations. From an Austrian perspective, 1936 was not the end of Swiss monetary virtue. It was the end of its structural guarantee. The franc's soundness would no longer rest on the discipline of gold convertibility. It would rest on the discipline of institutions, which is always more fragile, always more dependent on the particular individuals in positions of authority. That Switzerland managed this transition more successfully than almost any other country is remarkable. That it managed it imperfectly is what the rest of the 20th century and the opening decades of the 21st make abundantly clear. The Swiss National Bank, in its effort to suppress the appreciation of the franc, has accumulated a foreign exchange reserve portfolio that dwarfs Switzerland's entire economy. Recent figures put SNB assets above 700 billion Swiss francs, against a Swiss GDP of roughly 780 billion. a ratio unmatched by any comparable central bank in the developed world. To the layperson, this might look like strength. A rich country's central bank, flush with assets. To the Austrian economist, it is something altogether more alarming. Every expansion of the money supply beyond real savings represents a transfer, not the creation of wealth, the redistribution of it, from later recipients of the new money to earlier ones. Cantillon described this in the 18th century. The dynamic has not changed. Newly created money is not neutral. It flows through the economy like a dye through water, visible at first in certain hands, diffused only gradually and unevenly through prices. The SNB's interventions to weaken the franc have consistently enriched Swiss export industries, watches, pharmaceuticals, machinery, at the expense of Swiss households, whose imported purchasing power was quietly suppressed. And the policy of negative interest rates between 2015 and 2022, the longest experiment with sub-zero official rates in monetary history, was precisely the kind of suppression Austrian theory predicts will trigger malinvestment, capital allocation toward projects that look profitable at artificially low rates, but cannot sustain themselves when rates normalize. Swiss real estate prices rose to levels that bear no relationship to the underlying productive economy. The Swiss pension system was forced into increasingly risky assets in search of yield. Zombie firms survived on cheap credit that genuine market discipline would have eliminated. The most dramatic episode of this monetary suppression came earlier. On September 6, 2011, the SNB announced a minimum exchange rate of 1.20 Swiss francs per euro, pledging to defend it with unlimited foreign currency purchases. On January 15, 2015, the SNB abandoned the peg without warning. The franc surged 15 to 20% against the euro within minutes. The event, the Franken shock, remains the largest single-day move of a major currency in post-war history. The peg was always doomed. When a central bank artificially holds down the value of its currency, it is, in effect, lying to the price system. The exchange rate is a signal. It conveys information about relative productivity, capital flows, and the preferences of savers across jurisdictions. A pegged rate is a suppressed signal. Entrepreneurs, financial institutions, and households make decisions based on the false price. Building positions implicitly leveraged against the assumption that the central bank can maintain the lie indefinitely. When the SNB finally acknowledged what the markets had long suspected, that maintaining the peg would require a balance sheet incompatible with any plausible mandate. The repricing was instantaneous and brutal. Swiss exporters who had built supply chains around 1.20 faced overnight margin compression of 15 to 20%. Forex brokers who had sold the franc short went bankrupt. The SNB itself posted a loss of roughly 50 billion Swiss francs in the first quarter of 2015. This is what Hayek called the crack-up dynamics of sustained artificial price suppression. The longer the distortion is maintained, the more capital misallocated around it, and the more violent the eventual correction. There is no free lunch in exchange rate management. The peg did not prevent adjustment. It concentrated it, it delayed it, and it thereby amplified it. Rothbard would add a harder verdict. The peg was not a policy error. It was a structural feature of central banking. Central banks are not firms subject to market discipline. Their losses are socialized. The SNB's 50 billion franc loss was not paid by its governors. It was paid by Swiss taxpayers through reduced profit distributions to the Confederation and the cantons. The incentive structure of a central bank systematically encourages the kind of short-term political expediency that produced the peg in the first place. And yet, despite the peg, despite the negative rates, despite the dilution implicit in a balance sheet approaching 1 trillion francs, the franc has continued to appreciate. This is the deepest question the data poses. Why does the franc keep going up? The standard explanations: Swiss productivity, current account surpluses, safe haven demand in crises, are all true but insufficient. They describe symptoms without identifying causes. The Austrian answer begins with a simple observation about what money actually is. Money is not just a technical medium of exchange. It is a claim on the social order. Its value reflects the collective judgment of savers and investors about the reliability of the institutions, political, legal, monetary, that govern its issuance and its purchasing power. Switzerland's institutions have been, by the standards of the 20th century, exceptionally reliable. Direct democracy constrained profligate spending. Federalism prevented fiscal centralization. The militia army and strict neutrality minimized the state's war-making ambitions. The single most destructive force in monetary history. Rothbard's verdict on the relationship between war and monetary debasement is unequivocal. It is war finance, above all, that destroys currencies. Switzerland has not fought a war since 1815. The franc appreciates, in the final analysis, because Swiss institutions produce a lower rate of monetary debasement over time than any comparable jurisdiction. This is not a coincidence. It is not luck. It is the direct consequence of specific institutional choices: decentralization, direct democracy, fiscal conservatism, neutrality, that happen to align, structurally, with the conditions sound money has always required. The evidence is in the consumer price data. Across the past century, and especially since the United States suspended dollar convertibility into gold in 1971, Swiss inflation has run below American inflation in almost every year. The strong currency was both cause and consequence. The evidence is in the bond market. Swiss 10-year yields have averaged around 1.75% across the modern data history. American 10-year yields have averaged around 4.25%. The yield differential is not a cause of franc appreciation. It is, like the appreciation itself, an effect of the underlying institutional divergence. Bond markets expect the SNB to print less, and Swiss fiscal authorities to borrow less than their American counterparts. The evidence is in the exchange rates themselves. Against the dollar, the franc has moved from levels above 4 per dollar in the mid-20th century to well below 1. Against sterling, from above 10 to near 1. Against the euro and its predecessors, the same pattern. The trend has not reversed. It has paused. It has overshot in both directions. But across the full arc of the post-1971 era, the direction is one way. And here the story turns forward. The book by Costa Vayenas, which underlies this analysis, closes by asking what the rise of digital money, central bank digital currencies, stablecoins, privately issued digital currencies, means for a world in which the link between a currency and a sovereign territory is becoming increasingly optional. It is here that the analysis converges most strikingly with the most radical strand of Austrian monetary thought. Hayek's Denationalization of Money, published in 1976, argued that the root cause of monetary instability was the government monopoly on currency issuance. His solution was not to reform central banking, but to abolish the monopoly, to allow private issuers to compete, to let the market select for currencies that maintained their value and eliminate those that did not. Hayek's vision never materialized in the form he imagined. But the landscape that is emerging now, states and private individuals shifting toward new forms of digital money, jurisdiction becoming a key variable in asset value, is, in important respects, the Hayekian competitive monetary order arriving through the back door of technology rather than through the front door of legal reform. For the Swiss franc, this creates an unusual dynamic. Across most of the 20th century, the franc was the closest thing to sound money available to a global investor. It was the exit from dollar debasement, from euro inflation, from yen money printing. To a meaningful degree, it still is. But in a world where digital alternatives exist, the franc no longer competes on monetary virtue alone. It competes on institutional grounds: Swiss privacy law, Swiss property rights, Swiss political stability, Swiss rule of law. From an Austrian perspective, what this means is that the franc's long-term appreciation is no longer automatic. It will persist only as long as Switzerland's institutional framework remains genuinely superior to its digital and geopolitical competitors. The moment Swiss authorities move to control capital flows, to implement a CBDC that surveils transactions, to subordinate monetary policy to outside coordination, the competitive advantage that has driven 227 years of franc appreciation will erode. The Swiss franc is not a magic asset. It is the visible price of an institutional bet. A bet that decentralization beats centralization, that constraint beats discretion, that neutrality beats entanglement, and that the patience of savers eventually defeats the impatience of politicians. For 227 years, that bet has paid. The chart of the franc against every other major currency tells the story without ambiguity. The question, looking forward, is not whether the bet is sound. It is whether Switzerland will continue to make it. This is Game of Francs. The full article with the charts, the data, and the methodology is at gameoffrancs.com. Subscribe for the next one.